My name is Fausto Pugliese, President Founder of Cyber Trade University. Today's Saturday, 12 o'clock, February 8th. Welcome, and hopefully, I really appreciate everyone making the opportunity to make it here on a Saturday. And we have a very, very exclusive event today on a Saturday here at Cyber Trade University. We always do our events once in a while. We do a Saturday event for some of you that cannot join us midweek, maybe because you're working or just not the most convenient time, but we know Saturdays, obviously, it's always a time, especially a day around here. The weather is where you are, but here in New York, it's freezing. Looking forward to getting some warm weather over here. But today's topic we're going to talk about is the FX trading and the money management of 2014. Gregory McDermott, very, very well-known market maker on the options market and understands and trades the Forex market. We're very pleased to announce that it's one of our new instructors here at Cyber Trade University. And one thing you all know is we always bring instructors to come in here that are market makers, because that's what Cyber Trade University is about. The best way to learn is you learn not just from a trader, but from market makers that work on the floor. So you know what it's like, because we are the athletes and we are the coaches, and that's where you get to learn and you get your best knowledge when it comes to trading in these markets. Now, before we get started, everybody, just out of curiosity, where is everyone logged in from? Just always like to get to know where everybody is logged in. Okay, Kelly's from California. Okay, a little early. Florida. Okay, Eric, thank you. Adam is right here. West Virginia, Ireland, Tom, thank you. London, there we go. Got some Europeans here. Louisiana, Pittsburgh from Wayne. Calgary, perfect. Well, the thing I want you guys to know before I introduce Gregory and pass the ball over to him, and he's going to go over a presentation, just so guys to let you know that today's presentation is going to be for 2 days. There's a lot of content that we're going to cover, but we can't cover it all. And what we're going to do is Gregory's going to talk about, money management. He's going to talk about the FX market. He's going to talk about technical analysis and options also, if you could squeeze it in. And then what you're going to do is we're going to invite all of you back next week to come and watch Gregory and put all this to test in the real market conditions. And it's going to be free. Now, if you can't make it, that's okay, because it will be recorded. Okay, as long as you register for it. If you notice at Cyber Trade University, you log in your dashboard, you'll see the videos. Hell, you might even be able to access it if you like on your iPad or your cell phone if you can't be here at a physical computer. But everything is going to be recorded and for your listening pleasure. And you just have to remember, ladies and gentlemen, when it comes to trading, 90% of your time is not spent on trading. It's spent on learning. Only 10% of your time is spent on training, and that's why we're here. If you notice, you spend a lot of time doing research and learning how to trade, and that's what Gregory and I and all staff members and instructors at Cyber Trade University are willing to teach you, because we went through the same exact education when we first started. So, but the thing about the Forex market, just want to kind of explain a little bit. I don't know how many people here are options traders, stock traders, Forex traders, futures traders, but you got to remember, all of you, and when I mean all of you, we all need to understand how all the markets work, because they all interact with each other. There's only about a 30% difference of trading different markets, because they trade differently, but the psychology, the theory behind it, the style, the attitude, the preparation, everything that's involved is exactly the same. And that's why when I look at all people in any market that I know, we all trade exactly the same. We both have the same attitude. It's just we're all athletes. It's just a different game. And that, ladies and gentlemen, is one of the biggest mistakes that people make. It's it's not knowing how to play the game. So I don't want to take too much time away from Gregory. I'm going to pass him the ball. Gregory's going to close out the meeting. He's going to go on for about an hour. Feel free to ask him questions as you go along. In the meantime, everyone, I'd like to thank you all again for being here. It's an actual honor and privilege that you guys made it for Saturday, and I mean that, because for you guys to come out and take your busy day on a Saturday, on your day off, to be here to listen, and what we're going to talk about, you're going to see that it's well worth your time. And most importantly, everybody is going to go home learning something. All right? So, Gregory, the stage is all yours.
Appreciate that, Fausto. I guess I've got control. Good afternoon, everybody. As I was watching everyone log in and tell us where they were coming from, it reminded me of the looked like the opening ceremonies last night. I don't think we had two from the same place across the board of all of our attendees. So welcome to those of you outside the United States. For those of you like Fausto and I who are in the Northeast, everybody try to stay warm. We're going to take some time today and really focus on the FX market. Before we do that, you have to get all the legal stuff out of the way. So we're going to put up our CTU risk disclaimer. I'm sure everybody's real familiar with it. I'll give everybody a minute to read through that. We are an educational unit organization. We are going to give you some ideas, but on a Saturday, we're not looking for you to trade on any of those right away. So there's our disclaimer. About Cyber Trading University, everybody on this call is probably very familiar, but if you're not, CTU has been an educational trading institution since '95, established as a leader by first working directly with SOEs traders, firms teaching them to day trade. For those of you who remember the infamous SOEs bandits way back in the day, it's one of those old school terms. I'm sure Fausto's probably chuckling when he heard the SOEs bandit. CTU was one of the first to establish itself as a quality stock market trading school. Each instructor has a minimum of 6 years of actual trading experience before they begin to work with students. Over the past 14 years, have taught thousands of students how to be successful traders and profitable traders, and CTU's headquarters located in the heart of the trading world in New York. I appreciate, before we even get moving, I do want to echo what Fausto said. The ability to learn from people who have succeeded and failed is a great advantage, and that's what you find here. Real traders who have done, who have made money, lost money, and survived as traders. I've made more mistakes trading probably combined than everybody on this call, and live to tell about it, and you're going to benefit from that experience. The two words that I always try to harp and go back to when you're trying to teach someone about trading. Fausto said, everybody wants to start trading and they don't want to take the time to learn about trading. It's a patience and discipline game. I think one of the things I'll get into here, and you'll find as I teach these courses, is not doing something if that's your strategy and your thought out position is doing something. The fact that you look at a market, make a decision ahead of time, and choose momentarily to act or not act, both of those things, whether you act or don't act, they're a decision, and that's all built into your trading plan. The plan that you lay out for yourself, for your capital, for each individual trade is the key to success. So let's get into my second least favorite thing to do is to start talking about myself. I'd much rather talk to traders about trading than talk about what I've done. But as you can see there, got my master's degree in finance at Macquarie University in Sydney, Australia. When I got that degree back in 1989, I was the first American to get the degree. I highly recommend anybody who wants to go to graduate school. They ask me, they'll say, what should I do? I say, go to Australia on a scholarship, because that's the way I did it, and that's the way everybody should go to graduate school. Earned my BS at St. Joseph's University in Philadelphia, was a crude oil options trader and clerk at the New York Mercantile Exchange, eventually moved to be the head option market maker for JAS Securities at the Philadelphia Stock Exchange. At one point, I was managing a portfolio of my own plus 10 other floor traders. This was back through the 90s and the early 2000s. At one point, I was a market maker. In fact, I was one of the original market makers in Dell Computer. If anybody's looking at Dell stock these days, you may have forgotten what Dell used to be, because at one point, probably 1993, 94, 95, was probably the most actively traded equity option in the United States. We went from a crowd of about, I was the sixth person in our crowd, and at one point we probably were standing 100 in a space built for about 60, get up close and personal with all the other guys and women on the floor. I directed an off-floor trading unit for JAS Securities after I traded on the floor, and during that was qualified as a DTR for the International Securities Exchange when that opened up. Geez, it's probably been 10 or 12 years since the ISE opened up. So enough about me. Let's get to the good stuff. And just so we know, I'm reading the chat and I'm watching the screen. If for some reason I miss one of your questions, I will absolutely hang around afterwards to answer any questions that you may have. I respect everybody's time enough to try to go through this presentation, deliver what we promised in a timely manner. But if you need anything from me, whether it be after live here, or I'll be giving you my email at the end, be happy to answer any other questions. So don't feel like with a crowd this big, your voice can't be heard. I'll be happy to help anybody who needs some help. So let's get going. As a reminder, next Wednesday, we're going to be kind of doing part 2 of this. We're going to be doing it at 7 p.m. And then the following morning, 8 a.m., 8 a.m. Eastern, we're going to jump online, and I'm going to have my FXCM screens, MetaTrader up and live. I'll be running out of the demo account, and we'll be looking for some ideas, talking about the things that the practical application of the things that we talk about today and the things that we talk about on Wednesday night. So we'll be doing that live for an hour or so, 8 a.m. Thursday morning on the East Coast. We'll be catching the end of the European session and the opening, hopefully, in the U.S. market for New York. We'll be able to follow that link and get you to our live trading event. So we're going to start at the beginning. We're going to go very basic. I'm not going to bore everyone with all the minor details of all the intricacies of what is Forex, but just at a very high level, obviously short for the foreign exchange market. It's a market where traders come together to trade the underlying, in this case, spot currencies. The Forex market, unlike traditional exchanges, is an electronic exchange. There are no FX spot traders rubbing elbows with each other. You can have currency futures traders out in Chicago and other areas trading currency futures, but we're talking about the spot market here most times. In an electronic marketplace, one country's currency is exchanged for another country's through a free-floating exchange system. We'll touch on that free-floating exchange system in a minute. For many years, exchange was reserved for the government and large financial institutions. This was until probably about, I'm going to say 15 years ago, about that when the market started opening up to individual and smaller lot traders. There are many compelling reasons why the FX market should be part of your trading portfolio. It may become the part of your portfolio where you make the most money, but it's definitely something, as Fausto said, 75% of what you do from a disciplined mental preparation standpoint is the same, almost no matter what you're trading. But the ability to trade the Forex could be a great advantage. I see someone asking if we can show that slide. We will put the link up again for our next 2 sessions. It'll be at the end of the presentation. History of the Forex. You know, a teacher, he likes to go history first, so we know where we came from, so we talk about where we want to go. Obviously, it goes back to ancient times. The Bretton Woods Conference in '44 was one of the first agreements between countries on how monetary policy would be handled. The IMF also now influences that. We moved out of dollar gold pegging, which there used to be for many, many years. The dollar was set to a gold standard and other currencies were pegged to the dollar. Those sort of confinements and restrictions were taken out through the early 70s with the Smithsonian Agreement, European Joint Float, and the gold standard abandonment in 1973. As these fixed rate system collapsed, it allowed for free trading of currencies and the valuation of one to another. Forex market has quickly become the world's largest financial market. And when we say that, you know, these numbers are very hard to come up with an exact figure, but in general, the FX market's going to trade in the neighborhood of $2.5 trillion. And that is a number that is staggering. It's more liquidity than you'll find in all the U.S. markets combined. And with it spread out over approximately 18 major currency pairs, you've got unmatched liquidity. And that's one of the big advantages in trading currencies, is that there's liquidity available for the big and the small investor. And that liquidity allows you to nimbly move in and out of the market. It allows you to execute your trades with the minimal concern for slippage. One of those words you'll hear traders talk about is slippage, and people will say, you know what, I couldn't get my execution because, you know, I went to the crowd in the options market or the equity market, and, you know, I couldn't take out the offer, or I couldn't hit the bid. You'll find that the liquidity that's developed over the years with competition, when you're working with, you know, a really good brokerage firm, somebody like FXCM, where you're going to have relatively tight markets, which allow you to get in and get out, plan your strategy accordingly. I'm a believer that when someone comes to me and says, Greg, you know, I'm doing really great in trading, but, you know, the spread's too wide, and that's why I'm losing money. If you're losing money because the spread's too wide on your entry and your exit, you probably don't have a great strategy. It's just part of doing business. And in the FX market, that spread is very tight. Most of these major currency pairs trade a pip or two wide, so you can get in and get out and not give away profits on the entry and the exit. Why should you trade the Forex market? That's the question any of you who don't trade it should be asking yourself. We've touched on the fact that it is the largest financial market in the world. We'll touch on this again, but profit in up and down markets, something that can be difficult to comprehend and get used to. Part of that ingrained training that you have as a trader, you kind of all, in general, will think, you know, profits up, profits up, profits up. Unless you're an options trader, in general, that's your mindset. Well, this is kind of a different mindset. You can make money in a market as long as it's moving in either way. The fact that it's open 24 hours a day, 6 days a week, opens up late Sunday night, closes Friday afternoon, about the close of the New York market. What it does is it allows you to trade when you are able to trade around your schedule. If you're someone who can trade all day during the New York market, fine. If you're someone that works shift or you like to trade at night, you're a night person like me and you like trading at night, or you're someone who gets up early in the morning, you can find time in your day, and we're going to talk about some of the ways you can actually expand your reach beyond the minutes and the hours you can spend at your desk to trade and trade profitably. There is volatility. I'm going to show you a couple of charts later that will that's going to illustrate this, but you also have the ability to follow long and persistent trends. For any of you that like to trade using technical analysis, trends are what you can make money on. And what you will see is if you look at different time frames of a particular currency pair, you'll be able to find those trends, find the time frame that fits you best to trade those trends, and trade profitably. Only a few currency pairs to know compared to stocks. We're going to touch on that in a little bit. Also, risk management tools and more accurate analytical tools. You're able to manage your risk with the great software that's out there. You're able to use analytics and, again, focus in on a small number of currency pairs rather than a seemingly endless universe of, say, stocks or options. We really can mitigate the impact of manipulation and false data because the market is so big. The pool's so deep, it's hard for one person to make a big wave. And then again, the margins. I'm a believer that margins and the ability to leverage prudently your money is the key to success. And I don't want that ever to be misunderstood as let's just, you know, leverage ourselves to the hilt so that we can, you know, make big bets. This is not a gambling operation. This is a job. And if you take your job seriously, you can use the advantages of margin to turn a minimal risk trade into a profitable trade without at any one point putting your entire capital at risk. I do want to touch on this again. Profit in either direction. I know a lot of you, again, probably come from an equity market standpoint, and it's difficult unless you want to trade, you know, puts or put options trades on that capitalize in downward markets. Most traders come to the market with this mentality of up good, down bad. It's a very simple, and in most cases, that's what they've been taught, and that's what they've seen in their P&L. Well, in the FX market, there are no limitations. There are no limits on hitting on a downtick, short selling. There are no limitations. You're just taking, at its simplest form, a directional position for one currency and against another currency. And for example, if you have a euro-US dollar, it's just as easy to sell the euro-US dollar as it is to buy the euro-US dollar. And what this allows you to do is it doesn't give you a limitation for entry and exit into that trade. I'm sure you've all had a trade where you would have loved to hit a stock on a downtick, but that can be difficult based on the regulations. Well, in this case, there are no limitations to downticks, and downward movement is just as profitable as upward movement. And some would argue, and I know Fausto would probably agree with me, that usually a downward move can be exacerbated by the perception that up is good and down is bad. Rarely, you may see stocks, options, currencies, futures, you'll see them go to the downside hard, and you'll hear people throw the term panic around rather inaccurately and rather loosely, but that idea of, oh man, it's going down, and you get into a bit of a panic. Rarely does you hear someone use the word panic on an upside. Well, those downside moves can be more profitable because you've got people who have the mindset of up is good, down is bad. And if you've taken a position to the downside and it goes your way, the people who are trying to cover those long positions have a tendency to scramble more. And therefore, as they're scrambling, forcing it down, trying to get their position back and sell it, you can profit from that. So profit in either direction makes it a lot easier for you to find opportunity. You're not skewed for an upward one-way move. We talked about this before, but 5,000 U.S. equities. I'm not sure how Fausto has all of those symbols memorized. Somehow he does. I think he has all 5,000 of them memorized. I'm not that smart, and what I like to do is look at, there are 6 major pairs all set to the U.S. dollar, about 18 world pairs that trade with any sort of regularity. Now, if I brought up my screen right now for the MetaTrader with FXCM, I probably have, I don't know, there's probably 20-some pairs or more, some which never trade, but I have them on there just as a way as I go through my checklist and looking for opportunity. I know that if I'm going to trade a pair that's a little bit more thinly traded, I have to sort of prepare for, hey, again, the spread. What's it going to cost for me to get in? What's it going to cost for me to get out? What kind of a time frame do I need to look at to make it a profitable trade? But what this does is you can become an expert in those pairs that are set, say, just to the dollar, and a couple others. Let's call it 8 just for fun. 8 currency pairs that trade 24 hours a day, 6 days a week, and you can get used to them. I heard Fausto speaking yesterday to his team, if some of you were on that call late yesterday afternoon, and he was calling back to stock trades that they had done previously, noting, hey, such and such a stock is now moving. Remember when we traded that before? And it's helpful when you trade a stock that you get used to the way it moved. They kind of get their own personality some way. So if you can get 6 or 8 currency pairs that you get comfortable with, and you get used to the way that they move, you can anticipate moves from past history. You can look at the chart and say, look how this stock usually moves, for example, around the U.S. unemployment day. Like, how does it usually move? And you can go back in time and see, how does it react? How does it react one to the other? There are some currency pairs where trading one is almost like trading the other. What I mean by that, I'm trying to remember, I think it's maybe trading the dollar Swiss and the dollar pound, I believe. I'd have to double check it. But those, if you lay those charts together, they trade relatively similarly. So what you have to know is, boy, I sure probably don't want to double up and trade both of those positions long, because I'm really doubling down on an upward move since they both kind of move, they have a pretty high correlation to each other. so you can figure those things out, you can focus on what you want to do, and you can set your time as to where you want to enter your trades. So the ability to focus, I think, is one of the advantages of doing FX trading for us. The data. I know we've all heard and we've seen stories about insider trading and all those things that really give Wall Street a black eye and can occasionally, make the individual trader a little skeptical. Hey, am I really playing in a fair market? And obviously you are. But when you're talking about the Forex market, you're talking about a market that is so gigantic that it's very difficult outside of, certain governments stepping in and causing misinformation, which doesn't happen. You have the advantage of getting the information that everybody else is getting. You go to your basic websites that give you data, whether it's CNBC or any of the other sites that are out there. There's some, I'm not going to start mentioning all of them, that are specialized in Forex, and you can look for those sort of economic data. It's very difficult to have those whisper numbers come out and somebody know and somebody doesn't. So it's a very level playing field. And that's the key. Everybody's got a shot, whether you're someone with, a $2,000 account or a $2 million account, you've got the same information, particularly as we move into technology of 2014. We'll talk about that pretty soon. I think you've got access to data as quickly as anyone else, the ability to execute in almost instantaneous real time wherever you are. I think this really makes it a great time to trade FX. Besides the data, some people out there like to trade the fundamentals. Everybody sort of has what they like to do well. If you're someone that likes to trade fundamentals, you're looking at the simple comparison of one currency to another currency. The U.S., the pound dollar is what's the value of the pound in relation to the U.S. dollar. And it's, you've got a very simple economic relationship. In that simple comparison, how is the economy of Great Britain compared to the economy of the United States? Now, again, I've oversimplified that, but in general, that's what you're looking at. Are we in a period of time where natural resources are going to be going up? I heard Fausto say yesterday, he never likes it when he hears oil's going up. Well, if we're in a period where oil's going up, are we going to have, is the Canadian dollar going to take the lead because of all the natural resources they have and their ability a lot of times for oil to lead the commodities market in general in a direction? So that's something from a fundamental basis that you need to know. You want to know who's an economy that's going to be a borrower, who's going to be a lender, who's got natural resources. All those fundamental pieces add to the decisions that you make as an FX trader. The analytical tool. Probably a lot more of you are familiar and comfortable with trading with analytics. As we have here on the slide, the nature of the Forex, pronounced recurring trade patterns become evident, and therefore technical analysis really becomes a very important tool. FX's macroscopic environment nullifies wild trading events and aberrations created by periodic illiquidity and microscopic trading environments. So again, that big pool theory helps you see repeated patterns and not be taken out by real inconsequential short-term movements. And again, back to the data. It's all nice and clear, simple and easy. We're going to talk about analytics coming up. We're going to talk about how you can use indicators to help you trade. We're going to mention one coming up in the presentation. Those long, persistent trends, they allow you to look for opportunities, maybe on a time frame that you're not used to with FX, more used to it in stocks, where you may take a position that you think is going to pay off in a week or 2 weeks or maybe even longer. And the ability to use the appropriate order execution can allow you to ride those sort of long-term trends, just like you would if you were trading stock, using a moving stop loss, and you can also use a moving target to stay in a trade. You can drop in trailing stops, which allow you to maybe ride a trade longer than you would knowing that you've got protection of a stop. Here's a quick look. We're talking about long-term trends. This is yesterday's chart, pound dollar. And if you look at that, this is purely an illustration. I'm not telling you to go buy the pound dollar. I'm not telling you it's rolling over, although it may feel like it has. But it's pretty easy to see that that trend, that's a weekly chart. So since its bottom in about June of 2013, where we put that pivot in, that second pivot low, February they put one in and then we put another one in June, you're looking at effectively an upward trade for hundreds. And again, I missed the scale on the right-hand side. But that's a weekly chart with hundreds of points straight up. So the pound has been appreciating against the dollar. So if you were a trader who likes a long-term trade, again, not a lot of people trade on weekly charts, but this is just an illustration. The look at this shows you how, if you wanted to take that long-term view, you could. And there's if you were running with a trailing stop, and you had the patience to stay in this trade, there was profit for the last, 6 months. And now to take it to the other extreme, this is a 5-minute chart in the euro-US dollar from yesterday. And what I want to show you here is that as we're talking about trades, if you're someone who likes the long term, that's great. But inside of this euro-US dollar, you'll see the giant move at about, it says 1,500 hours. I'll give everybody a guess as to, this was yesterday's chart, and you'll see the movement here. I'm never good at grabbing the pen. Okay, no one laugh if I try to grab this pen and highlight this and something bad happens. So there's no laughing allowed here. If you look at this area here, and you can all tell that I did not spend any of my lunch money on art classes, that area there is a 5-minute chart, and that was during yesterday's unemployment announcements. So what you see there is there was a giant move up and correction within about 15 minutes, 20 minutes, about 4 bars there, which offered short-term trading. But if you had been in that position for a longer-term run, you can see that the reality is, I'm going to try this again with a different, although we took it and made this giant move up, you're still holding this same, again, no laughing at my drawing ability, but you're still holding this trend line. So within the security of trading an upward move on a trend line, you got a couple of moves. And even if you didn't get out up here and it came back against you, it dropped back into its familiar pattern and went to an upside move. Now, if we looked at this chart on a 1-minute, it would look more volatile. If we rolled it out to a 15-minute or a 30-minute chart, it'd look a little less volatile. And why I wanted to point this out is, if you're someone who likes to trade actively and thinks of a weekly chart as something they could never look at, a daily chart is not enough movement for them. They kind of want to trade actively. These 5-minute intervals, 1 minute's a little difficult. I use that more for indicator rather than trading off a 1-minute chart. But like a 5-minute chart, a 15-minute chart lends itself to active trading. And within the movement over a day, if we looked at, and I don't have it here, if we looked at what was the high and low in the euro-US dollar, if you looked at a daily chart, you might see a relatively stagnant day and think, oh, wow, it wouldn't have been any money to make. And if we look at, you dial in and look at 5 minutes, wow, maybe we did have some money to make in here. And that's what we're going to talk about over the next few days, the ability to look at different time frames, look for a setup, and try to capitalize on those moves within the moves. When you've got a prevailing uptrend in for example, like a 4-hour chart and a 1-hour chart and a 15-minute, you see everything sort of trending up, and you find an opportunity within this chart maybe to buy on a pullback. You buy on a pullback against one of these, against this support line, with the idea that the 4-hour, the 1-hour, and the 30-minute are all pointing up. I'm getting an opportunity to get in here to lean against the trend line. That's a trade I'm probably pretty interested in. So again, we're going to talk about more of this later. I'm trying to play with the eraser and it's not working, so we're just going to keep going to the next slide. I do want to tell everyone, if you have any questions, I know I'm going over a lot of stuff. As I said earlier, I'll be here afterwards, and I'm always available via my email. Be happy to answer any questions that you might have. I'm now just crossing my fingers that those marks don't stay on the next slide. So we are going to clear my annotation. Well, I hope that does it. Oh, it worked. Great. I would have bet that it wouldn't. Hedging and risk management. We're going to move into the risk management piece. Stop loss orders are much more effective in the Forex market than other markets. I'm going to give everybody a moment to think why. Why would you think the stop loss in a Forex market is a lot better than most other markets? The reason that I believe it is because the stop loss is in place all the time. The market never closes. When you put a stop loss in on a stock, someone just said it, Eric just said that, gaps can really kill you. If you have a stop loss in, one of the misconceptions in the market is that your stop loss executes at the price that you put the stop loss in. If you had a stock, again, just an example, and it was trading at $40, and you had a stop loss in at $35, and the market closes today at $40, and you think, well, my stop's fine, I'm not going to get taken out, I'm long. Bad news comes out. You know, their earnings are horrible, something bad's happened, and the stock opens at $20. The misconception is that, well, I'm going to get executed at $35. Well, the reality is the definition of a stop loss is your stop is activated once the underlying trades at or below your price, and it then becomes a market order. So in our simple example, your $35 stop, opening trade happens at $20, you're executed at $20. So the fact that the market can close in equities can occasionally open you to the ability to get your stop not be as effective. But because the markets are always open in the Forex, the amount of money you can lose back to slippage again. Yes, you could have a stop loss at a certain level, and you could get filled slightly below that. But in general, you're not going to see a significant loss below your stop because the market is always open. Now, the only time you really are at risk would be Friday afternoon, and that's why a lot of times you'll see Fridays, particularly late in the day, if an underlying currency pair has moved one way for a significant period of time, either that day or during the week, you'll find a lot of people, you'll find it coming, maybe reversing back with people squaring up their position because you don't know what's going to happen. As the gaps can be bad with an equity every day. God knows what can happen between 4 o'clock on Friday and 7 o'clock Sunday night in the world we live in. And that exposure, if you went and looked at the charts, you'll see that a lot of those moves on Sunday night can be significant gaps. And if you had to stop, you're at the same risk as everybody else. So squaring up your positions at the end of the week is normally a good idea, unless you've got a reason and maybe some other, we'll talk about later, ways that you could ensure that position. Forex does have listed options, foreign currency options. They trade on currency futures. You can use those in a couple of different ways to hedge your position. Being clear, the only real disadvantage you have there is that some brokerage firms will require you to margin those differently. That becomes a sort of an asset allocation difference because you may not be able to trade your spot currency and your FX options in the same account. Although for you, you're hedged, they may double margin you. Again, much more detail than we want to get into today. Risk management tools along with charting packages are offered free of charge with many direct access trading platforms, including FXCM, who offers a couple of different ways to trade through their system. We're going to talk about it in a little bit. Offers really great technology, including sort of the FX standard MetaTrader 4 or 5. Again, 24 hours a day, 6 days a week. Last time I'm going to harp on this, but if you're somebody who likes to trade at night, you could find yourself getting comfortable with Asian currency pairs and trading, late in the evening on the East Coast. If you're someone who's in Europe, I mean, your morning starts with the European market, which is normally one of the busiest sessions. Wherever you are in the world, you can find a time that you can trade for for profit. And with the technology available now, you're no longer tied to your desktop. In days past, even a couple of years ago, it would have been unthinkable for an FX trader to put on a position and walk away from their computer. It just would never happen. And now, wireless technologies allow that to happen. So you can get the information you need where you are, actively manage, and be a profitable trader. Here's that I was talking about, the opportunity with FX. It's so much easier. This screenshot is from our friends at FXCM. You can get web station trading platforms. You can get it on your desktop. They have mobile devices. As you see across the bottom here, let's put the little highlighter. I mean, I've got MetaTrader up and running. NinjaTrader is a very popular form. These are other ways for you to enter trades, and they're offered at all the with all the sites for FXCM. And what I mean by this is, if you're trading 6 or 7 pairs, and let's say you have, you're somebody who wants to trade early in the morning, and you get up at 5 o'clock on the East Coast, and you can trade for a couple of hours, but man, I've got this one trade, it's hanging out there, I'm making money on it, and it's my Euro-US dollar, and it's 7:15, and I have to take kids to school. Well, with the availability of iPhones and iPads and Android and laptops, you can get, in fact, FXCM offers a really nice software for the iPhone that you can manage your trades live. So you can set the trade as you know, early in the day. You're watching it. You know it's set. You've got your stop. You've got your limit. You have your exit strategy. One of the most important things, exit strategy. And you can walk away and know that the market's not going to close, so you're not susceptible to gaps. And at your convenience, you can kind of keep an eye on that. You know, you can check while you're, if you're at work, if you have a minute, and you don't necessarily have to actively manage it every single minute of every single day, but you can remain in profitable trades. You can stay abreast of the market. You can do it on your time, and that's the big advantage we've got today. It's never been easier to track these trades. I'm sure if you told somebody, 8 years ago that you'd be able to put in a trailing stop and a profit and a take profit limit order on a buy of a Euro-US dollar, and it would just send you a tweet. First of all, they would say, what the heck's a tweet? But it would send you an email and tell you you've got a confirmation. You can set your phone up to know those things, execute. You can manage the trade if you need to. Most times I suggest people I like to have a notebook and sort of a what am I trying to do plan. And if something moves my way and I want to roll with the trade longer than I originally anticipated, it's a couple of clicks of your mouse and you're moving on. So it's a great opportunity now to free yourself from your desktop, trade around the job you have, or trade around the other things that you're trading every day. Now I'm going to go back to the screen. Oops, didn't want to do that. Let's clear all this stuff and get me my pointer back. There we go. Let's talk about one indicator. Someone I saw noted it early in the discussion on the chat. Relative strength. Again, all of these things we talk about are tools. There's no, and I want to be real clear about this. There's no magic. Anyone who tells you that every trade they do is a winner and they win all the time, Fausto's nodding his head now, I'm sure, but those people are not telling you the truth. Everybody has losing trades, and the key is managing those. So no one's going to be able to tell you that, oh, this indicator always works in and of itself. What I like to do is take things like relative strength and look at them in conjunction with the entire market, and what do I see in front of me, and what does my experience tell me? Again, I can't convey my experience to you. I've had people say to me, well, what did you see there? And there are times, and I'm sure there are a lot of you out there who have been trading long enough, you're not sure why you saw what you saw, but you saw it. I know that sounds kind of like, it does sound like magic, but it's not. It's experience, and there's a difference. And what we're going to talk to you about today, relative strength, is a key, is something to look at, is a way to filter down what are my opportunities. And relative strength is not only available for FX. It works in conjunction with other indicators on anything that you're trading. It was developed by J. Wells Wilder and introduced in '78. It's an extremely useful and popular momentum oscillator. The idea we talked about earlier is trends and momentum. RSI compares the magnitude of a stock's recent gains to the magnitude of its recent losses, turns this information in a range of 1 to 100. It takes a single parameter, a number of periods used in the calculation. In the book, while they're recommended 14 periods. You can modify with the trading technology today, you can modify those periods to anything you want. But what we're looking for is relative strength. Compared to what else is going on, where should this trade? I apologize, I know this is not the best looking chart, but what I wanted to point out to you is down here is the RSI. So we are at a point where, if I can get this to right, down in this area, again, my drawing abilities severely lacking. But our RSI is very, very low. We're looking like we should probably be able to make a move, to be anticipating a move to the upside based on this so weak against its comparables. So if we look at the next chart, this is where a blow up of that chart was a spot trade pound versus the US dollar. You can see some other things on the chart, but we're only focused on the bottom with the RSI. It's also, as you can tell, kind of inching down at the end of its Bollinger Band, which is running through the middle. That might be a modified Bollinger Band with a 0.8 deviation. I usually like to run that one better. And again, here's where the trade went off. It's just an example, nothing more than that. Back when it was trading a little bit higher, this is an older example that I pulled. What did I do in this case? We bought, paid 1.9440, executed it out. Took the limit, made, I don't know, about 100 pips, I think, on the trade when it finally, we left the stop below where the support was, put in an OCO. Again, this is just an example of what can happen if you recognize a trade with other factors with RSI. How can you sort of use that to your advantage to try to make a swing quick trade in the FX? The example that we laid out here just shows, about a $98 profit on a very small trade. We made about 70 pips or so, something like that. So again, this is nothing more than hey, this is how an RSI indicator, relative strength, one of the things we would look at. I normally would not jump into a trade just because, wow, the RSI is really low, so I'm expecting it to reverse. I want to get in a trade. But it is something that I use as part of my, I'll use the word checklist. What are the things that I go through to make sure that I've got most of my arrows pointing in my direction? I can make this the most favorable trade, and at what point, what level am I going to get out? If we went back here and looked at this chart, the level where the other reason I would have made this trade is, I'm going to use the pen again. There would have been a support level, which you can't really see because I'm drawing blue on blue, but right below here, these were a couple of lows. So I was making it with a relatively low RSI, and I had support here. There would have been a stop just below there to take me out if I missed it and it was going to break that support. So again, purely an example, some of the things that we're going to talk about over the next couple of days, and we'll see when we do the live trading. The last piece, money management. I really believe that this is the way to be a successful trader. Years and years ago, as an options trader on the floor in Philly, actually no, I was still in New York trading at at the Amex. I may have even been a clerk. And I remember one of the guys I was trading with saying to me, as a market maker, your job is to be picking up nickels and dimes in front of a steamroller. And when you start reaching for dollar bills, you're going to get crushed. And it's something that stuck with me, I don't know, 20 years now. It's been since I was hanging out in the upper deck at the Amex, going to get lunch for people. Back in the old days, that's how you learned how to become a trader. You first had to figure out how to make sure you didn't screw up your trader's lunch and how to prevent them from yelling at you. That was the way you learned to trade. This is a little bit more civilized. But back to originally what I said and what Fausto echoed as we began, it's patience and discipline. This is not, oh, I'm going to trade FX and going to be, retiring next week. No, this is a job. And here at Cyber Trading University, we're going to help you learn how to do that job well. You're going to benefit from the experience that we've had, the mistakes we've made, the successes we've had. And the key for me is really the money management. And I know firsthand that one of the most difficult things to do as a trader is to take a loss. Like, saying sold or clicking the button and just locking in a loss is an awful feeling. Trust me, I know. But the worst feeling is not clicking the button, not saying sold, and letting a loser ride. Because once you do that, you're really getting outside of your game plan. You're then really rolling the dice, and that's not what you want to do. There's always going to be another trade. You can always find new opportunities. And I believe when you get into a trade, I like to have in my notebook written down, where am I getting in and where am I getting out? Now, am I telling you that every single time I get exactly to my stop that I, within a pip, get out there? No. But I have a very, very, very small tolerance for avoiding what my original plan was. And what I find is a lot of people will tell you that if you do this or you do that, trade goes for you, trade goes against you. Here's how I can turn this loser into a winner. And what a lot of people won't tell you, and I will, is the answer a lot of times is get out. I have a rule that if I find myself staring at the ceiling at night over positions that I may have, it's time to get out of those positions. Your mind's telling you something. So getting out of your position, although it's no fun to lock in a loser, is always an option. And you can make a better, more clear-headed decision without a position on than if you're stuck trying to turn this loser into a winner. Cut your losses, move on. And what you need to do is be able to capitalize on your winners and hold those losers to a minimum. If you look at this, the math that we laid out here, if you had a $5,000 trading investment, your risk tolerance 5%, probably a little, absolutely as much as you would want to risk, and I probably wouldn't even suggest that. I prefer down around the 2%. And again, this is not let me just take one big trade and walk away. It's how can I consistently make trade? And what I like to do is I like to look at a 2-for-1 profit margin. I like to, in the case up here, I'd like to lose $100 and make $200. Lose $250, make $500. You get the idea. Simply making it a 2-for-1. If I can get my winners up towards twice my losers, I'm in a much better, it's just simple math. Simple math even I can do. If you look at a bigger dollars, let's say you had a big account. The dollars look bigger. They can get a little more scary because risking 5% of your $20,000, to me, probably not the way to go. I'd like to have a bigger bankroll to do that. But the same idea works. You're looking at being able to target a specific loss and a specific gain based on your built-in predetermined targets. Again, sticking to that plan will work. And it's very simple. What percentage of trades, of winning trades do you need to break even? And a lot of you are going to be surprised that you only need to have 1 out of 3 winners. To break even. Now, none of us are here to break even. We could all come up with silly analogies that we won't get into of what it's like to break even. Some would involve someone's sister. We won't get into those. But what I'm saying is, if you look at the math and stick to the plan, if you get 1 out of 3 right and you stick to the plan, you're looking at breaking even. None of us are here to break even. But what that shows you is you don't have to be right all of the time to be a profitable trader if you manage your bankroll correctly. If you look at this, we don't want that to be the case, but this shows that you can be wrong more than you're right and still make money. Simple question I have is, do you have the discipline to prove the math we've laid out correct? We're going to talk about, I've taken you right up to about 5 minutes left to go. I'm going to leave some opportunity here for any discussion you guys may want me to go over. I will remind everybody that we're going to get together again Wednesday night. We're going to talk a little bit more in depth about FX trading. We're going to probably go into, maybe even touch on some option stuff for you. We're going to maybe look at some more live examples. And then coming back on Thursday, we're going to go live trading in the morning, 8 a.m. East Coast time. I'm going to fire up the MetaTrader on FXCM, and it's going to be up and running. And I'll take your questions. I'll be able to pay attention more to your questions. I apologize. It's difficult to try to narrate this webinar and track your questions. You see the link sitting down there at the bottom. Greg has put that up there for me. If you click on that link, that will get you to our next live trading on Thursday. And I'll flip this back. I do want to let you guys know it's coming up. Yes, we can get you copies of the slides. So here's what thank you, Deborah, for asking. Did you know it was coming up? If you need me to email me for a copy of the slides. If you have any questions, my email is greg@ctutrading.com. I'm also going to write on here, I have a paper that I wrote. It's just an informal one. If you're someone who's brand new to FX, you're not even sure before you got on the call today, on the WebEx today, that FX stood for foreign currency. If you're a basic beginner, I have a short paper that I wrote. It's called Pips and Pairs. It's the basics of FX trading, explaining to you about the way a quote comes out in FX. What does dollar versus yen mean? What does yen versus dollar mean? What's the base pair? What's the counter pair? All of those very, very basic things that I didn't want to talk about here. I'd be more than happy to send you that email. You send it to me directly. I'll get it right back to you. It's yours to keep. Couple-page article about those basics. Again, I called it Pips and Pairs. You can email me at greg.m@ctutrading.com. I'd be happy to send you the deck. I would be happy to send you the paper, and I'm more than happy to answer any specific questions that you might have. I'm going to go back up so that you guys can see what our event's going to be. I'm going to go this way. Okay, that is the last one. I'm going to leave that up there for everybody. Again, my email, I'll type it in so everybody has a copy of it. It's greg.m@ctu. You know you're not a good typist when you're calling the letters out as you're hitting them. greg.m@ctutrading.com. We're right up towards 1 o'clock. I would like to echo Fausto's sentiments from the beginning. I really appreciate everybody taking some time on a Saturday to spend an hour with us to talk about how, with our friends at FXCM and CTU, Cyber Trading University, how we can help you either start your FX trading career, expand your FX trading career, or just add FX to part of the portfolio of things that you trade on a day-to-day basis. So I really appreciate everybody being here today. Again, that email address, greg.m@ctutrading. I will leave this slide up for a while in case any of you need to jot down when you can join us on Wednesday night or Thursday morning, and I would be happy to send you these slides, and I'll be happy to send you the short article, Pips and Pairs. Fausto, do you want to come back on and say goodbye to everybody? I am up against 1 o'clock, and I really appreciate everybody's time today. Thanks, guys. I will stay here for a while if we can leave this. If we can leave this on, I will try to watch the chat now and answer as best I can any questions that might pop up. If you can't get in, if I missed your trade and you can't get to me, or I'm just getting old and miss you as you go by on the chat window, feel free, email me anytime, and I'd be happy to get you any information that you need. So thanks, everybody.